Hello guys, so we'll be starting with new topic, that is investment decision, chapter number 7. Okay. Found that? Where will you find? Nothing you have, no? Okay. All right. So when we had started our discussion of FM initially, I told FM essentially involves 3 decisions. One is your financial decision, another one is your investment decision, third is your dividend decision. These the decisions only are made as different topics in your topic is what we had told. So far we have covered those topics which targeted the financial decision. Cost of capital, capital structure, leverage and all were around under the financial decision. Now we have this and one more topic which comes under investing decision. Investing decision means we have discussed this initially when we did where to invest. Okay, basically like we told you after, see, whenever you want to do a project, no, to do that project you need money. To raise the money you can either issue equity shares, preference shares, a debt or retain earnings or whatever. So after raising the money, will you keep the money idle or will you invest it? Invest it. Okay. So where to invest, how much to invest, if you have multiple projects, how to select them, etc., gets covered under investment decisions. Okay. Oh, so now in fact, when first chapter also I told you, basically you will invest either to buy fixed assets or working capital management. Yes. So for how much to invest under fixed assets, I had told you that it gets covered under a technique known as capital budgeting. Okay. So yes, so those capital budgeting techniques, etc., we'll be learning in this particular topic. That's the overview of this. Okay. Basically where to invest the money, or if you have already done the investment, whether the investment you have made is giving you the required rate of return. That's all we'll be studying under this particular topic. Okay. Okay, there are a few theory concepts. Let's quickly run them by. Then again, important topic, out and out numerical question, numerical based. And we do have few concepts. Let's cover them up. One, we know that the analysis is done through a technique known as what I told, capital budgeting. Capital budgeting is basically a technique which tells you whether to do the project or not. Or if you have already started the project, it tells whether it is giving you the desired rate of return. One, what is the purpose of capital budgeting? Why should we worry about these investment decisions? Or you can trace it back here. What is the big deal about, or why should we give emphasis on this investment decision? There are actually many answers. We'll stick to the things given over here. That we can call it as slick. Okay. Slicko. Kikkala. Slicko. Okay. All right. S for substantial expenditure. Sir, when you want to do a project, the money requirement will be what, 1,000 rupees, 10,000 rupees, or it may go in crores also. Especially if you are a manufacturing entity and all, the money that you need to do a setup could be in like thousands of crores also. Yes. So the amount of expenditure these decisions involve, is it on the lower side or higher side? Higher side. So that's what we mean. Since the amount is big, can you be reckless or you need to be very careful? Because one decision is wrong, that could mean the end of business itself. So many startups, they start left, right, center with so much josh. They approach. Now anyway, Shark Tank India and all, you'll be able to see full picture. Okay, this we'll do, that we will do. We'll capture this much market, revenue projection, 1,000 crore, 10,000 crore. After 2 or 3 seed round of funding, shut down. Why? Few decisions gone wrong. Okay, so hence there is a necessary to pay attention to this, because the amount of expenditure that is required for these projects are very huge. It could mean one decision could mean the death of business literally. Hence, that's the first one. Okay, that's your L, substantial expenditure. L is for long period of time. Suppose we decided to do a CA course. Okay, we enrolled the students and all. Can we back away, or it has a long-term impact? If you have started to do any business means, if let's say you bought machinery worth 100 crores rupees now. Okay. That decision, can you replace the machinery within next year only? Like we have purchased camera, these assets and all. in the very next year, after using for 1 year, we will throw away and buy the new one, or it has a long-term impact on. These expenditures will impact your business for a very long period of time. So that's the reason whenever we bought this camera, do you think just like that we bought it, or we did a research? Which TV should we buy, which laptop should we buy, which mic suits us, what is a laptop. In fact, normal laptop doesn't work for recording. It has to be a gaming laptop. Processors has to be on the higher side, otherwise laptops will crash. You'll not be able to withhold so much of weight, especially. So we had to do a lot of research, because if you don't do it, then puss damar. Okay, so yes, so this decisions affect your business for a very long period of time. It could be for 3 years, 10 years, whatever. Okay, especially big companies, when they set up huge projects and all, no? The machinery and all will last for 10 years, 15 years and all. So you should be very careful where you buy the machinery from, what kind of machinery you buy, where to install it, who should operate it. All these decisions you need to take it very wisely. Hence, there is a necessity of this particular technique. Got it? One, a substantial expenditure. Two, it impacts your business for a very long period of time. I, for irreversibility. Once you take the decision, it is like Tirupati Hundi. Once you put money into it, can you take it back? No, it is gone. No, these decisions are also like that only. Once you take it, whether good or bad, you have to kind of stick with it, because the amount will be huge. No, so you can't suddenly say next year, if I buy a machinery now, if it is useless for me, second year, can I scrap off this and buy a new one immediately? No, because I may not have that much of money power. So these decisions, majority of these decisions could be or maybe irreversible. Okay, because it is not easy or economically feasible to reverse these decisions. Last one is complex decisions. Like when we decided to go for recorded classes and all, right? Okay, we need to estimate, because there is a substantial expenditure. Like we have our own app. Yes, that means there is a technologically we have invested heavily on that also. Correct. That means we have to estimate how many students will opt for recorded classes. Yes or no? At what price should we sell? Okay. Will they come for face-to-face class, or are they actually interested in recorded classes? Like this, we need to estimate our selling price, our customer's decision, our customer base, etc., etc. You need to estimate. Sir, will your the estimates means will you estimate just for 1 or 2 months, or you are estimating like 3-4 years down the line also? You could estimates could be long term. Long term estimates, can you make it? Can you be absolutely pakka with them? Can you make it? Can you make perfect estimates? Or that could go wrong also. Estimate could go wrong. COVID is a perfect example. Before COVID, everyone was giving big bashing. We will like, this economy will become world's first economy, second economy, trillion economy and all that. Once it came, there was no economy only left. Yes, no, it looked like that. It looked literally like a doomsday. Okay, yes or no? So that means what? These are quite complex decisions, because you're trying to predict the future. Okay, customer action, your pricing action, etc., etc. You're trying to predict, and these prediction cannot be made with absolute certainty. There is always an element of error and things going wrong. Hence, these decisions are quite complex. So hence there is a need for a technique known as capital budgeting. That only we are calling it as SLIC for our class purpose. Okay, one S for the expenditure is quite substantial, meaning significant. L for it has an impact over a long period of time. I for these decisions are irreversible. C for these are complex decisions, because you are trying to predict the future, and it is not so easy to predict the future, no matter who you are, what you are. Okay, hence there is a need for it. That's the first. Can I move on to the next one, sir? Or capital budgeting process. What does, or how do you do the capital budgeting is, first I'll just tell you once. Planning. Okay, maybe we'll just go through it once. Planning, evaluation, selection, implementation, control, and review. These are the process involved in capital budgeting. Let's take maybe our academy example only and try to see if we are able to relate it. Okay, sir. Sir, when we started the academy, first decision we had to take was whether you want to give coaching under a commerce field or science field. Since all of us were commerce graduate, that was easy decision for us. So we decided commerce, because we were chartered accountants personally. So we wanted to offer CA ka coaching. So under commerce also you have many courses, no? CA, CS, ACCA, CMA, USA, CPA, blah, 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 blah. So that means those were the investment opportunities available with us. We could either taught CA, CS, CPA, anything. Yes, that is your first stage, planning. See where and all you have opportunity to do the project, or which and all project is available for you to take up. That is your first step. Got it, everyone? Okay. Second is evaluation. Okay. Now we got to know that under commerce we have CA, CS, ACCA, CMA, blah, blah, blah. That and all is opportunity is there. Can I just like that randomly take the decision, or I have to evaluate each plan? I have to evaluate each course. Like we decided we'll start the academy in Bangalore. First step is how many totally number of students are there for CA in India? Total number of CA students in India. Okay. Among that, how many CA students are there in Bangalore specifically? Okay. If they are there in a remote part of Bangalore, will they be able to reach our academy? So next point is to estimate how many students are close enough to our academy, or how many colleges are close enough to our academy, so that from their colleges they can come to our academy. This is okay. All right. Then how many teachers do I need to hire? Yes. How much investment it will require? From the students, how much fees we can charge? Basically, how much return can we expect? All these will come under evaluation stage. Okay. Basically, the risk and the reward of each type of investment we will analyze. Got it? That comes under which plan, sir? Evaluation. Got it? Planning is what? Identifying the opportunities, investment opportunities. Evaluation is finding the risk and reward of each plan or each investment opportunity. Okay, we decided. We found out the cost benefit analysis of every course, CA, CS, everything. Then what you will do? When you do everything, or maybe you will start with one. Maybe you will start with one. Okay, let's say we decided we'll select with, or we'll go for CA. That is your third stage. That is selection. After you do the evaluation, next step is to select a particular project based on the risk and reward. Okay, each company ka risk and risk appetite could be same or different. We may be willing to take higher risk. There could be another academy who are probably willing to take low risk. At CA, if I have to take CA foundation is less risky affair, but doing CA coaching for CA final is a more risky affair, because you will not find good teachers at CA final level, because it is quite difficult. The syllabus is quite voluminous. Teacher has to put in a lot of efforts to study. I personally can vouch for that. Okay. It was among all the courses that I've taught I'm teach still about 7 subjects. Among all of them, if I have to say which literally I put in the most effort for, hands down CA final. Nothing can beat it. Nothing even has come close to it. Okay. You wouldn't believe that I used to study daily 10 hours for 4 months, later 3 months. Syllabus was voluminous because at that time, when I studied, it was accounting standard. But now what we have syllabus is Ind AS, IFRS. When I was a CA, I had not studied Ind AS. So I had to put in so much of effort to study, then to make notes and all this stuff. Okay. Coming back, where did I say all this stuff, by the way? We got lost in between. Okay. Okay, that's for another day. Meaning, yeah, the risk appetite of each things are different. That was what I was trying to say. Is it okay? All right. So from the academy's perspective also, it is probably less risky to start CA foundation coaching and probably more risky to start CA final coaching. That is the reason if you just check in the market also, you won't find too many CA final teachers. CA foundation, you'll find a lot of them. CA intro is also okayish. CA final, hardly a few reputed ones if you just see. Because yeah, it requires that much efforts, and it is, everyone at the end of the day has to study. If you are a teacher, means you also need to study. You can't escape from it, and nobody likes to study. Hard fact. Okay. After CA also, our halat is what, sir? We still have to study because we have to know to teach you guys. So that much effort, probably some of them are not willing to go for. Okay. Anyways, coming back to this. So you'll basically select the project based on the risk and rewards. Got this? Next is, okay, I selected the project. I decided that I'm going to do CA course. That's all. Select and keep quiet, or you have to do some more actions. What actions will next come into play? To do CA course means you need a building, take it on rent. Yes, you need some assets to conduct the business. Buy those assets. You need to hire some teachers. hire them. If you need to invest in app, invest it. Okay, if you need to do some marketing, do it. All that will come under implementation stage. Implementation is like what you do after class. What do you do, sir? At least I say you study. Do you? Okay, that is your implementation. Is it okay? That is what you need to implement to clear your examination. Is it okay? That's your implementation. Okay. Next is control. So control is a process of constantly monitoring the project with a tool known as feedback. In fact, feedback is one of the means through which we have improved as well. In fact, I personally, if I have to share my experience, I think I've been teaching, as I told you, since many years now. It's only in the last 3-4 years I've started making the chart book. I didn't have the chart book back then. I used to just give the normal notes. Then one day I decided, okay, let's try the charts for accounting standards and see what happens. I gave it, students said it is actually good. It's actually helping us to revise sooner. Then for all my subjects, I made the chart book. One of the reasons was feedback. Basically, you'll be able to improve your process through the feedbacks that you'll get from your customers or your target audience. Yes, this is what happens in your capital budgeting process also. Continuously monitor your action because there will be always a scope for improvements. Is it okay? That is your control stage. Last is your review. Finally, you just check as a CA student, what do you like to look in your marks card? Pass. When you're doing a project also, check whether this project is an ultimate, it's a pass or it's a failure. Success or a failure, you need to revise. Okay. Let's say I expected a return of 15%. I achieved a return of 18%. That means it is a success. I expected a return of 15%, but I ended up making only 9%. Probably it is a failure. Okay, so that is your review stage ultimately. Okay, these are the steps involved in your process involved in your capital budgeting. What are those again? First is your planning. At planning stage, you identify what and all opportunities or investment opportunities are available. Then you will evaluate each of them. Okay, how much is the risk involved in them? How much is the reward involved in them? Cost involved, etc., etc. You do the analysis. That is your evaluation. After evaluating, what you will do? Whatever suits you based on risk and reward, you will select one. After selection, you need to acquire the necessary resources to implement the project. To get the project started, you need to buy whatever resources are necessary. Then you control the project. This is your continuously reviewing your project to just see, or continuously checking the project to see whether it is going on the right track. Could be done through one of the means known as your feedback reports. Lastly, finally review whether the project is a success or whether it is a failure, depending on your expectations. What was your expectation and did you achieve that or did you not achieve that? Gives you whether or tells you whether it is a success or a failure. Easy peasy. Can I go for the next one? That time of the day already? New chapter no should be okay. Correct? No, that's the reason we started that time of the day, new chapter. Okay, types of capital investment decision. Types of capital investment decisions. For our class purpose, we'll call it as red camera. Where do you find all this? You are able to remember, no? Remember. Where or not, don't ask. Okay. All right, red cam. What is this capital investment decision, or what does this R stands for? R is your replacement decision. Let's say it's only in the last, probably I would say just before COVID, probably we went into online coaching. That's when we started. Okay. Before that, let's say I was using a, let's say 4-year-old laptop. We need laptops to do a normal operation, no? So our office ka average age was, all the laptop was about 4 to 5 years old. They were regular laptops. Okay. Using that, can I conduct online classes or recorded classes now? No, because for recorded classes, you need high speed processors. Otherwise, system will crash. So what should I do? If I have to go into the recorded mode of class, what I have to do? Can I use my old laptop? I need to replace them. That is your first decision. If you have an existing asset, check whether they are worth it or should we actually have to replace them. Because at some point of time, doesn't matter, you need to replace all the assets. Now we have purchased this mic. Will it last forever? Maybe it lasts for 3 years, maybe for 4 years. After that, I still need to, this will become worn out. So I need to what? Replace them. That is the first kind of decision, capital budgeting decision you need to make. Replacement decisions. Okay. E stands for your expansion decision. Everyone would like to expand. Yes, any business for that matter, they are happy with their existing status or they want to still grow. Doesn't matter if you're even if you are a world's richest person. Will he say I am satisfied, or will he say I still will expand my company? Okay, he will still. Everyone's aim is that only. Yes, no. Where is the end? You don't know. That becomes spiritual. Let's not go there. Okay, but at the end of the day, everyone is looking for expansion. Correct or no? Okay, so that is your expansion decision. Currently, we may be looking at expansion decision of, let's say, opening up another branch other than in Bangalore. Maybe we are looking into it. Let's see if it happens or not. Is it okay? So that's your expansion decision wala thing. Opening up a new outlet, etc., etc. Would be your expansion decision. Self-explanatory. Okay, D for diversification. There in your next page. D for diversification. Diversification means, let's say, sir, you became a chartered accountant. You qualified. I don't know why you're sitting in the class. Maybe you like me too much. Okay, doesn't matter. You're still sitting in the class, but you're already a chartered accountant. After CA, you thought you kuch tufan hi karte hai. So you come into practice. Okay, because practice is a little bit of a challenging, especially initial few years. Okay, so you started your own practice, sir. Sir, your interest is in DT, direct tax. That is what you liked. Okay, you like the subject. Okay, that was your probably the paper where you scored highest maybe, or you felt good whenever you studied the Income Tax Act of 1961. There's always a smile on your face. Maybe, I don't know. Could be not, may not be. That's okay. All right. So you wanted to obviously practice in which area now? Obviously, you can't practice in all the areas. So you probably need to specialize. So you decided you're going to specialize in direct tax. So you started the firm. Okay. Let's say one client came and told, I want accounting service and I need some auditing service. But you want to do only direct tax. Now you are in dilemma, whether to shoo that guy away or take up the assignments. Your mind is saying, show him off. I don't want him. But your brain is saying, you still need to eat. So you need to take it up. Okay. So what you said was, okay, I'm not interested in this DT assignment. You check with one of your friend. Good friend he is. He or she also cleared along with you only. He wants to, let's say, specialize in audit or accounting service. You know what you did? You told, instead of doing a solo practice, let's go Janti. Okay, instead of going solo, let's do a partnership firm. Is it okay? Like this, we call it as diversification. Your area of work, you want to revolve around which area? DT. But your client has come up with what assignment? Audit. But you don't want to do it, but rather you give it to your friend and tell 80% of the revenue you keep, macha, 20% you give it to me, because we are doing under individual name or partnership firm name. So this revenue sharing game, you agree with your partner. Assignment you do, maximum revenue you keep, minimal amount you give me. This is okay. This strategy is your diversification, which practically many of them do also. That's the reason you say majority of the partnership firm in practice, or practice, if you see the names, no, majority of them are partnership firms. You hardly see sole proprietors because it is quite difficult to kind of survive as a sole proprietor, especially if you don't have a good backing or good knowledge also. It takes time to build the knowledge. Theoretical knowledge is one thing and applying it practice is different. Practically, you should be able to convince your client. Your fees should be optimum. Okay. Your knowledge should be very, very high. So there are a lot of factors at play. Okay. So if you want to play safe, you can go for something known as diversification strategy. Is it okay? For us, diversification will be what from our academy. Can you tell me? Earlier we started with CA and CS. Now we are offering ACCA also. We are offering CMA India also, CMA USA also. We offer CIMA also. Currently we are offering it at college level only. Is it okay? So from one course we are moving to, or rather we are not moving, we are also providing additional courses. Is it okay? So that is your diversification, because if one course takes a hit, the other course can compensate. So that is one of the idea behind diversification. Got the meaning of D as in diversification? Can I? C is your contingent decision. Contingent decision means 1 plus 1 offer. 1 plus 1 offer. Sir, what, sir? What is this 1 plus 1 offer? Okay. We want to give live online class now. We want to do a live online class. But unfortunately, it's quite possible that some students may miss out on some class due to our electricity board, our internet mata. Yes, if these fluctuate, it's possible that the student may miss out on few classes. Possible. That means we may have to give some backup. For backup, we need to give it either on a Google Drive or we have to give it on our app. I want to do one recorded live online classes, but at the same time, I also need to invest in recorded classes also, because one is coming with the other. If you want to do one, you also have to do the other. Like CA papers tell, no? If you want to clear the whole group, you have to clear, or if you want to say pass, not just one subject, you have to pass in all the subject. If you suppose in one of the subjects of group, if you fail, institute will tell come and repeat the whole group, because they are contingent decision. There it is 1 plus 3 offer. One goes means write all the 4. Okay, but at least we are better. We are offering 1 plus 1. Okay, now that is it. Now another example is, let's say you want to start a factory in a very remote area. Okay, there are no roads. The government unfortunately has not taken much interest in that area. Limited number of people, but you felt for your line of business that is a perfect location. You started, but how will people come to your factory and work? Because there is no road or transport. Your idea is to start a business, to start a factory, but can people workers come and work in your factory? No. That means you may end up building some roadways, some small gullies also you may have to probably construct, or give some transport services, because otherwise employees come and work. So if you're doing one means, you may have to do another one also. You want to do business here, but you also need to build infrastructure along the way, because otherwise the business cannot survive. Those decisions we call it as contingent decisions. Easy. Okay, so we covered C over here. Next is accept or reject decision. Accept or reject decision means, let's say there are two projects. If you want, you can accept one and reject the other. Meaning one is not dependent on the other, rather both are independent projects. So you can choose one and you can reject the other one. Such decisions is accept or reject decisions. Or simply you could say CA, CS. If we want, we can offer CA coaching also, CS coaching also. Or if we want, we can only offer CA or only offer CS. Are both the course same or different? Syllabus is different, probably teachers are different, target audience are different, yes or no? So that these are your accept, reject decisions. Okay, you can select one and you can outrightly reject the other as well. Got it? Last is M. M stands for mutually exclusive decision. Mutually exclusive decision means one is dependent on the other. Okay, so meaning you can't do both. You can only do, or rather, like you could say, one or the other. Let's say you have a project 1 or project 2. You can't do both the project. Either you need to select project 1 or you need to select project 2. Such decisions we call it as mutually exclusive. Now you have selected CA course. Will you also do IAS along with it? Because both the courses require sufficient amount of time. You may say, okay, I will enroll. But normal audience, is it possible to take simultaneously both the course and clear also both the examination? Very, 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 very hypothetical. Maybe one after the other is okay. After CA, we have seen few people going into IAS and cracking it. Okay. Simultaneously, people will do both the toughest courses in India. Probably no. Yes or no? So that means they are what decisions? Mutually exclusive. So you have chosen CA means you have let go of, or you have gone off what? IAS in my example. Because you can't do both, time wise doesn't matter. I mean, it's not feasible. Or you want to buy a phone. You're selected, you will buy one Galaxy, which is the latest version of Galaxy going on. S23. Okay, you decided I want to buy S23, but your mind is also on iPhone. iPhone latest version what? 14 Pro. Okay, 14 Pro Max or whatever. I'm not a big fan. I mean, of either. Anyway, all right. So your mind is saying on latest Galaxy versus latest iPhone. Both you will buy or only one? One. Because it is what sort of decision? Mutually exclusive decision. So I have money, I'll buy both. Okay, I'm not talking to you. Talking about general population over here. Okay, now. So these are your decisions that you need to end up taking. Red can. Okay. R for replacement decision. E for expansion decision. D for diversification decision. C for contingent decision. A for accept or reject decision. M for mutually exclusive decisions. It will come in exam, sir. Might come, who knows. Our idea is to just cover. Comes means right. It doesn't come also. Right? No. If it doesn't come, don't write. What is asked only you write. Okay. So will they ask theory in exam, sir? Yes, 10 marks in, I told you on the very first day, no? 10 marks in your FM paper will constitute theory. Generally, chapter number 1 and chapter number 2 is what they prefer for theory, but from other chapters also, sometimes theory questions do get picked up. Okay. Estimation of cash flows. For your decisions, no, here, capital budgeting decisions, you need to find out something known as cash flows, not earnings. We don't want profit. All these decisions are based on cash flows. There are few things in detail, may will not go. Problems will cover everything. One quick review I'll just give for each of them. In detail, may as and when we cover the problems, we will spend. One, on a depreciation, you need to consider the tax shield. Somewhere they would have given. Not given. Okay, live. Okay, here they give. Consider tax shield or tax benefit. I'll tell you what to do that. In today's session only, we'll work out one problem. On depreciation, you have to consider the tax benefit. Opportunity cost, no, you consider it as an outflow. Somewhere they must have given, no. Not given, no. Somewhere not given. Okay, I just underline this part. Consider, or maybe here, Baju may you write opportunity cost you consider as a outflow. Sunk cost, no, you ignore. It's already sunk. Why you want to? Someone is already dead. Why do you want to revive them? Leave them. Sunk cost you ignore. Working capital, no, initially you consider it as an outflow, and at the end you consider as an inflow. All these are problem specific adjustment, which we will discuss one by one when we hit the problem. For now, if I explain, it will not make much sense. Leave it out. Okay. On depreciation, you just need to consider the tax benefits. That's all. So these are the things that you need to do whenever they give this adjustment in the questions. Everything will come. Don't worry. Okay. Now I think theory is over. Can we, for today? Small bits and pieces will come here and there. Can we take up a question? Only 4 questions. That's all. Once we are done with 4 questions, we can all say tata bye-bye to each other. Very, very happily. Okay? Okay, can we get started with the question if you are through with the things? First question, sir. ABC Limited is evaluating purchase of new machinery with a depreciable base of 1 lakh. Its expected economic life is 4 years, meaning this asset will last for how many years? 4 years. The change in the earnings before tax and depreciation, meaning before paying tax and before deducting depreciation. Depreciation is an expense, no? Expense you will reduce from profit or you will add to profit. Expense you will reduce, then only you will get the correct amount of profits. Yes, no? So they're saying earnings, meaning the profit, before tax and before depreciation. Before deducting depreciation and before deducting tax, your depreciation or earnings is how much, sir? 45,000 in year 1, 30 in year 2, 25,000 in year 3, 35,000 in year 4. 4 years ka profit they have given. But this profit is before deducting 2 components, tax and depre. Assume straight line method of depreciation and tax rate is 20%. You are required to compute the relevant cash flows. So for investment decisions, no? Okay. Or basically maybe I'll just give you a little background. if you want to take investment decisions, initially you have to invest, meaning there will be an outflow. Like if I want to do a CA project, initially I have to buy all some assets. So there will cash will come to me or it will go out of me. So that means initially there will be, or initially only we call it as year zero. Year zero means now. Now I need to invest, meaning the cash inflow or cash outflow. There will be a cash outflow. Let's say the project ka life is 5 years. So from year 1 to year 5, I will be able to recover. That means there will be some cash inflows. Yes or no? This inflow and this outflow, I will compare. Then take a decision whether this project is worth doing or should I not do it. And we find. Hence, the relevant number here for these decisions are not earnings, it is the cash flow. What? That's it. Okay, that is what we are trying to estimate here. What is your cash flows? You are required to compute the relevant cash flow. Very simple question. So let's quickly put it up. Computation of annual net cash flows, I will say. I'll just write NCF. NCF is your net cash flow. Every year, if you compute that, it becomes your annual net cash flows. Sir, how many years data have they given to you in this question? 3 question is this first question only, okay. They have given 4 years data, no? So let's do it parallelly. Particulars, year 1. Sir, have they given first year how much you need to invest and all? Yeah, but they're asking us to compute the relevant cash flows. When they're saying we're talking about cash inflows over here, we are only trying to calculate the net cash flows. Even if you want to put year 0 ka cash flow, it should be fine. But what they're looking for is year 0 ka cash flow, any which way they only given. So there is nothing to compute over here. So computation aspect, these are working notes, okay? These are not actual problems that will come in exam. These are just the working notes that you will see in your bigger problems. We're slowly building towards that. Okay, 4 years ka data. Sir, have they given, what have they given in the problem? They have given cash flows or they have given earnings? Earnings. Specifically, which earnings check they have given? Earnings before tax and depreciation. Let me write the same thing. Earnings before tax and depreciation. How much is this number year on year? First year it is 45,000. Next it is 30,000. Then 25,000. Lastly 35,000. So I want to do the presentation ulta. Whatever you have taken horizontal, I will do vertical. No problem. Do it. No big deal. Okay. There's no order. That this only has to be vertical. This only has to be horizontal. Nothing like that. Any sort of things is okay. Sir, they have given earnings. Earnings means profit, no? For our decisions, we want profit or cash flow? Cash flow. And moreover, this earnings is after considering everything or before considering 2 things? Before tax and depreciation. Is depreciation an expense? Yes. That means after deducting all expense, then only you will get the correct earnings. And then on that correct earnings only you will pay tax to the government, no? Yes, or randomly you will pay off now. And then you will work out the earnings. You have to deduct all the expenses, whichever needs to be deducted. Then you will get the correct profit. And on that you pay correct amount of tax. First I have to deduct what here then? Deduct depreciation. Because before paying tax, all expense needs to be deducted. Okay, check everyone. Sir, you bought a machinery for how much value? 1 lakh. Have they told salvage value is 5,000, 6,000, 10,000, blah, blah? You know, straight line method ka depreciation. All of you have done, I believe, in your CA foundation, BCom, wherever. Depreciation is given by original cost minus the salvage value or residual value divided by the useful life. Correct. Actually, it is remaining useful life, but okay, nonetheless, useful life. Okay, now. All right. You bought this asset for how much value, sir? 1 lakh. That is your original cost. Original cost means the price that you pay when you buy the assets initially. For this asset, you spend about 1 lakh minus salvage value. Have they given salvage value? No. Actually, depreciation base means one after deducting salvage value only, but no problem. That we'll discuss in accounting standard 10 later on. Okay, divided by what, sir? The useful life. How much is the machinery ka life, sir? 4 years. So what will be our depreciation every year? Depreciation every year will be 25,000. That I have to deduct every year. Deduct it. Okay. Any questions? So depreciation was not deducted, which I deducted now. Has tax also deducted? No. That means here what am I going to get? Earnings before tax. So how much is this number? Here it is 20, here it is 5,000, here it is actually 0, here it is 10,000. Okay. This is your earnings before tax. Okay. From this, I need to pay some money to the government as tax. No? So hence what I have to do? I deduct the tax. How much is the tax rate that they have given in the question? 20%. Okay, calculate. This will be 4,000. This will be 1,000. This will be 0. You don't have any profit, so tax element also will be 0. 10,000 into 20% will give you 2,000. So what is your earnings after tax, or EAT is what you used to call it till now? Earnings after taxes, here it is 16,000, here 4,000, and here it is 8,000. Any problem? Okay. Check the screen. Last step now to find out annual net cash flow is you will add back depreciation. Oh my God. Okay. How much is the depreciation you deducted, sir? For each year, how much depreciation have you deducted? 25. Go on adding that back. Sky is high, so. Why on that? Okay. Are we good with this? This number we call it as annual net cash flow. How much is this number? This is 41, this is 29, and this is 25, and this is 33. Answer over, question over, everything over. Class not over, that's all. Fine, sir. Can anyone tell me why I added back? No, you deducted because depreciation is an expense and it should be deducted to get the right profit and to pay the right tax. I'm not talking about the deduction. That is right only. Okay, any expense for that matter should be deducted. This was not, hence be deducted. Why did I add back? That's my question. Perfect. Depreciation is a online also many good right answers are coming. That's awesome. You add back depreciation because the depreciation is a non-cash expenditure. Meaning, okay, you deducted 25,000 depreciation here. Yes, everyone. Sir, inflow means whenever you're calculating cash flows, inflow means I'll show it as a positive number. Outflow means I'll show it as a negative number. So here you have deducted depreciation. That means when you think from cash flow perspective, you are treating this as an outflow because outflows are deducted, inflows are added. You have deducted depreciation here for all the years. Fine, fair enough, because it is an expense. You have every right to do so. That is to find out your accounting profits. No? Here, financial management decisions are based on accounting profits or based on cash flows. Cash flows. Okay, you deducted. Did you pay anybody? Salary means you deduct and you pay somebody, correct? Now, if you deduct salary 25,000 means you have to pay the worker. You have deducted depreciation 25,000. Will you pay anybody 25,000 cash or check as depreciation to anybody? Hey, le macha, take 25,000 depreciation for you. Will you give a check or cash like that? So what sort of an expenditure is this? Depreciation. It's a non-cash, yes or no? But you have deducted over here. That means it looks like you have shown it as an outflow. Is it really an outflow? No. Hence, what you do over here? Add. Is it okay? So that means why deduct it in the first place at all? Because here you're deducting, here you're adding. Might as well skip it. Depreciation is an expense, and on that expense you get some tax benefit. Depreciation is deductible for tax purpose. See, here you are not, are you paying tax on 45,000 here? You calculated tax here, 4,000. On which number did you calculate tax? 45,000 or 20,000? 20,000. You paid tax on this number, correct? Did you pay it on this number? If you don't deduct depreciation, you're supposed to pay tax on 45,000. Will anybody pay tax on 45,000 or 20,000? So on depreciation, you get some tax benefit. It may be non-cash expenditure, but still it is an expenditure, and on expenditures you do get some tax benefit. That is what we wrote over here. On depreciation, you need to consider tax benefit. Okay, that's the reason first we deduct, pay the correct amount of tax, then you add back. Automatically the tax benefit will be considered. That's all. Now is it okay, sir? That's all. Online also cool? The reason is depreciation is a non-cash expenditure, and on that you will get some tax benefit. That's the reason. Oh, great. One down, 3 more to go. That's all. I don't know whether you're keeping countdown. It looks like I am keeping countdown this time for a change. Okay. Maybe that time for the day for me, or not. Still fresh. Or fresh. So only 2 problem. One guy to literally cut one only. Only 2 now. Why are you adding me saying? Okay. Alright. This is over. Next. Copying also done, huh? Or anyone still copying? Huh? Can we? Alright. Now we'll go into the techniques. Capital budgeting techniques. You'll find a lot of techniques. First is non-discounting techniques. Sir, have you already computed IRR? Don't ask me what is IRR. What does IRR mean? Implicit rate of return, you could say, or internal rate of return. Yes, formula also we are told. What is that formula? Let's see. First numerator. Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower. Yes, we have done enough number of problems. Okay, that is one of the techniques. Capital budgeting techniques. We have also found out NPV. NPV is one of the capital budgeting techniques. But when you found out IRR, just because we have done that, I'm giving a reference. Don't worry. Some of you have joined in for the first time. Any which way we will do it. Okay. Alright. Well, when you found out IRR, you consider something known as what, sir? Discount factor. Yes or no? Because the values given were future value. Using discount factor from future value, you found out the present value. Is it okay? That means these are IRR, etc., are techniques which considers the time value of money. They are known as discounting techniques. The techniques which uses time value money concept, we call it as discounting techniques. But now we are studying non-discounting techniques. Meaning they don't give a damn about the time value of money. That discount factor, etc., is blatantly ignored in these sort of techniques. In fact, that is one of the disadvantages of these methods also. Are we okay? Alright. So, meaning about it, non-discounting techniques means they consider time value of money or don't consider. Or rather, they ignore time value of money concept. They feel getting the money today is the same as getting the money after 5 years also. Okay. So, but in reality, is it true or makes a world of difference? Makes a world of difference. Okay. Those concepts, these techniques ignore. First such technique is payback period. Payback period. Payback period is simple. To do a project, will you invest some money? Will there be an investment? Okay. Let us say to do the project, you have to invest 10 lakh rupees. At some point of time, you need to recover all this money. No? Let us say you will recover all this money in 4 years. You will recover entire 10 lakh by the end of 4 years. So basically that 4 years only is your payback period. That is the meaning of the term payback period. Simply how much time you will take to recover your investment. The time taken to recover your investment, we refer it to as what, sir? Payback period. Okay. All right. That's the meaning. Okay. Now, I'll just maybe draw a quick graph. As far as the payback period is concerned, no? I've written in the chart also. I'll just write it for your reference. First check your net cash flow, NCF. Just now we didn't give. First check if your annual net cash flows. Maybe I'll write like this. Check if your annual net cash flow is same or constant. Same or constant means every year whether it is same or not. First check that. If the answer to this question is yes, then payback period is given simply by the formula II. Maybe I'll write initial investment divided by annual net cash flow. Initial investment divided by annual net cash flow. If the answer to this question is no, every year my net cash flow is going on change. First year it is 10, second year it is 13, third year it is 40,000. That means it is same or varying. If answer, meaning if your net cash flow is not constant, then you have to use something known as cumulative approach. Both I will show or take you through the problems as well. One problem is there for each of them. We will go through that. I'll give you a short target today. Che. Feeling bad. We'll add one more. Huh? No. Deal is locked, is it? Okay. No worries. So, meaning of the term payback period, you understood? Payback. Now look at the happiness. Oh. Okay. Payback period means what? It is the time period taken to recover your investment. In how many months or in how many years you will recover your investment. That is what payback period is trying to measure. For that, check whether your net cash flow, is it same or is it changing? If it is same, means simple formula, annual investment divided by, or rather initial investment divided by annual net cash flow. Okay, let's apply this in one other question. It is there over here only. Excuse me. A project cost rupees 20 lakh. So to do this, to take up this project, you need how much money, sir? 20 lakh. Can I say this is your initial investment? This is your investment required. And yields annually a profit of 3 lakh. So cash flow or profit? Sir, they have given profit, but for our analysis, we use profit or cash flows? Cash flows. So they have given annual profit of 3 lakh after depreciation. After depreciation means they are yet to deduct depreciation or already deducted. They have already deducted profit after deducting depreciation. And what is the rate of depreciation? 12.5%. And which method? Straight line method. After deducting depreciation, profit every year. In fact, how much is the profit? 3 lakh. But that profit is before tax. Depreciation they have already deducted, but tax they are yet to deduct. So we need to first compute what here? Now first we need to compute annual net cash flows, because given or we need to find. They have given profit, but we need cash flows. First find that, and then we can find out the payback period. Okay. So let's take up this question number 2. So working note number 1 is to find out your annual NCF, that is net cash flows. Okay, how many years data? Oh, actually, this is the same in which way. It's okay. All right, sir. Anyway, here I have to make many columns, or just a couple of columns is good enough. Why? Because they told every year profit is 3 lakh. Did they say it is changing? That means what? Annual net cash flow in this problem will be different or same? Since profit is same. See, use common sense. Profit is same. Depreciation is also same. So obviously the net cash flow that you're going to get is what? Same every year. So they have given what, sir? Profit, we'll write the same thing. Profit, what did they use? What term they said? Profit after depreciation, but before tax. How much have they given? 3 lakh rupees. So depreciation is already deducted. Should I have to worry about the deduction again? No. But is tax deducted? Not yet. So what I'll do? Deduct the tax. At what rate? Tax rate is 50%. So calculate, sir. 3 lakh ka 50% will be 1,50,000. So your profit after tax is what? Same 1,50,000. Are you interested in profit or are you interested in cash flows? Cash flow. So hence that's it, or one more step. One more step. What is that step? Last may add back depreciation. Why are we adding back? Because it is a non-cash expenditure, but on this you will get some tax benefit. Tax benefit I've already considered. Now it's a adding back stage. Depreciation. So what is the project ka investment, sir? 20 lakh. And what is the rate of depreciation they're saying? They only told 12.5%, and that too it's a straight line method. So 20 lakh into 12.5%, if you calculate, 2,50,000 is a depreciation under straight line method, which you need to add back. What is that? So how much will be your annual net cash flow? Annual net cash flows will be 4 lakh. So you got your annual net cash flow. Constant or changing? Huh? Annual net cash flow is constant. So every year you are recovering 4 lakh. Now can we find out the payback period? Okay, so now it's time to find out that payback period. Payback period is simply given by the formula. First, since annual net cash flow is constant, we can use the formula approach. Okay, so initial investment divided by annual net cash flows. Initial investment they told us 20 lakh, and every year you're generating a cash flow of 4 lakh. So what is your payback period? 5 years. Isn't the formula logical? Every year you're recovering 4 lakh. Totally how much you want to recover? 20 lakh. So 5 years, if you recover 4 lakh, are you not going to get 20 lakhs? Hence payback period is given by this particular formula. That's it. So payback period is 5 years in this particular case. Anything you want to copy? You want me to zoom in? Problem is over. That's pretty much it. Copying also done, huh? First problem you want to copy, Ada? Hey, where were you, Ada? Okay. Next. Question number 3. XYZ is analyzing a project requiring an initial cash outlay, as in initial investment is 2 lakh, and it is expected to generate cash inflows. Sir, did they give profit or cash inflows only? So they have only given your annual NCF, no? For our decision, we need annual net cash flows. Have they not given that specifically? Okay, given. Yes, annual cash inflows they've given every year. If you just check the number, is it same or changing every year? So you can use the formula only if annual net cash flow is same. Because you'll have only one annual net cash flow. You can easily plug into the formula and get the answer. Here you have one cash inflows or multiples. So that's what I wrote in the chart over here. If your annual net cash flow, if it is not constant, no, you need to use something known as cumulative approach. Okay, let's see how this question works. Question number 3. Again, finding the payback. Calculation of payback period. So first copy the data that they have given. So year they have given, and then they have given annual cash inflows. Okay. and then you need to have cumulative cash inflows. These are the three columns necessary. First two columns or first two columns ka data will directly copy from the question itself. How many years have they given? 4 years. So 1, 2, 3, and 4. Then annual cash flow, they have given it as 80,000. Then 60,000. And then again 60, and lastly 20,000. These are the cash flows given. Now, how do you find out cumulative cash inflows? Is okay. You have anything else to add above this, or this is the only number available? First year you are, and what is the only earnings or only cash flow you have earned? 80,000. So cumulative cash flow will be same, 80,000. Okay. Second year, to get the cumulative cash flow, no, you have to consider second year ka cash flow also, and along with that, first year. Meaning by the end of second year, totally how much have you earned in the form of cash inflows? That's what we mean by cumulative cash inflows. Cumulative means from the day one till the current period, how much cash flows have you actually earned? You are in second year now. Till second year, totally how much have you earned? First year you earned 80. Second year again you earned 60. So the total will be how much? 1,40,000. Yeah, we should go on adding. Correct. Okay. Now we are in which year? Third year. This means from the beginning till third year, how much totally have you earned? You can actually take 140, and to that directly you can add 60, or you can add all these three also. Any which way is okay. You can either do 140 plus 60, which gives you 2 lakh, or add all the things individually. 80 plus 60 plus 60, that will also give you 2 lakh. Your comfort. So everyone okay? Now you are in which year? Fourth year. Add all the cash flow ka value. It will be what? 80 plus 60 plus 60 plus 20 again, which will obviously be 2,20,000. Now simply take 2 lakh. To that you add 20,000. You'll get the number. Okay. That's your cumulative cash approach. Pretty straightforward. Okay. Sir, how much did you invest for this project? 2 lakh. Now check this 2 lakh, which year are you recovering? First year, totally you recovered how much? 80. By the end of second year, totally you recovered how much? Third year, you have recovered how much? 2 lakh. And what was your initial investment? 2 lakh. Therefore, payback period, you are recovering by end of which year? Therefore, your payback period is, therefore, your payback period happens to be 3 years. Easy. That's all. Any confusion? No confusion? Straightforward? Okay. Copying. Done with copying? No doubt? You should ask one doubt. No? Still okay. Time is there. What is that one doubt you should ask? What is that one doubt you should ask? Oh, okay. I'll ask you. If you don't have any doubt, means I have a small doubt. Please clarify. Suppose initial investment was 2,10,000. What you will do?
3 years, 5 months.
What the question? Here, initial investment was actually 2 lakh. So you went looking for that 2 lakhs in this column. So you logged in 3. So it was perfect. Win-win for everybody. Suppose that investment, it's not 2 lakh. It is rather 2,10,000. What is the question? Possible this scenario can also work out. Yeah, she's trying to answer. 1 minute, sir. I'll come to you.
So we'll take year, months also.
You take months also. Okay. Fine. Anything you have to add?
Take average of second and third.
You will take, so you're saying 3.5 years, huh? Could be in this case. Okay, suppose I write it as, okay, let me just see. I think I have given you a perfect example there. I'll make it to 2,05,000. Then maybe exactly it is not coming to average. In this case, what you'll do? Possible, no? It could be anything. 2,03,000, 2,02,500, 2,08,500, could be anything.
4 years.
He's saying, why are you worrying, Dad? It'll come in fourth year, right? Take 4 years now. 4 years you take. Fourth year it is coming. Yeah. Yeah. You have anything more to add? No. She's like, you consider something you said. What did you say by the way? You consider months also, you said. Okay. How do you calculate months? Okay, correct only. But how do you calculate? Oh, correct only. I would give you that. Correct only. How do you calculate months? Okay, how many months? Huh? 12 months means 3 months. 3 plus 12, it will automatically become 4 years. No, ma? If I consider 12 months, then. Okay, check, sir. Yeah, this scenario also, I think question is not there like this in study material. I think I'm not sure. Okay, nonetheless, whether it is not there or not, we will look into it. God, no, this also could be. Maybe we'll just do it as an extension. Suppose initial investment was, let's maybe take it as 2,05,000. Any number is okay. 2,05,000. How it works is pretty much what he said only. Sir, third year, how much is your cash flow? 2 lakh. Okay. Is your initial investment 2 lakh or little more than that? Little more than that, because our initial investment is 2,05,000. That means, are we able to fully recover in third year? No. Recovery is happening by the end of fourth year. You are able to recover everything, but does not mean 4 years is a payback period. Okay. So from third year, you went to fourth year. Cumulative cash flow from 2 lakh became how much? 20, because you earned how much in the fourth year? 20,000. That means, can I say you earned cash flow and months? I'll not take it in years because this could spell out in months as she mentioned. How much cash flow did you earn in the fourth year? Rather, from 2 lakh it became 220, means the cash flow you have earned is 20,000. This is the cash flow for the whole year. Whole year means it is 12 months. Okay. Sir, do you want to earn 20,000 for you to reach the payback period, or how much more you need to earn? By the end of third year, you have already earned how much? Third year, you have already earned 2 lakh. Your aim is to recover how much? Your aim is to recover the initial investment, which I have assumed it to be 2 lakh, 5,000. So how much more you need to recover? 5,000. Because still third year, you have already recovered 2 lakh. That means if I recover 5,000 more, I will hit that payback period wala zone. So to earn 20,000 cash flows, if you are taking 12 months, means to earn this 5,000. Why? How this 5,000 we got? 2 lakh 5,000 minus 2 lakh. How many months will you take? This is your proration approach. So X is how many months here? How do you calculate that? 5,000 into 12 divided by 20 gives you how much, sir? 3 months, because these are in months, no? So X also you will get it in months. Therefore, your payback period is not 3 years. 3 years and 3 months, or rather 39 months also. If you want, you can write. So in about 3 years and 3 months, you will be able to recover all your investment. Okay, that's the thing. If you want, you can just copy this also. This is an if scenario. This also could come in the examination. So now everyone clear how to calculate? So it's not necessary that it should perfectly tie out. It could be different also. If it is different, you'll have to do like this. Online cool now, everyone? In terms of the answers or solution, what we've got? This is your answer. Payback period is 3 years, 3 months. So how is it 3 months? We worked out now like this. Cash flow is 20,000. How did you get this 20,000? From third year, you went to fourth year. So your payback period is in fourth year. You agree, no? Because up to 3 lakh, up to 3 years, you have only earned 2 lakh. But you want to recover 2 lakh 5,000. So recovery is happening in the fourth year. Fourth year, totally how much have you earned? 20,000. So 20,000 is the cash flow for the whole year, meaning for 12 months. Okay. Till third year, you already earned 2 lakh. How much more you need to earn to reach the payback period zone? 5 more thousand. Yes, from 2 lakh, if you to go to 2 lakh 5,000, you need to just earn 5,000 more. 20,000. To earn 20,000, you are taking 12 months. To earn 5,000, how many months are you taking? It's a cross multiplication scenario. I think you have done that. Yeah. Just do the cross multiplication. 5,000 into 12, you will multiply. So divide it like this, cross multiplication. Now, okay. All right. Okay, someone said doubt, so that means let's construct one more example. Let's say example is let's say initial investment is a 2,17,000. Possible, or maybe we'll make it as 2,15,000. Can you now calculate the payback period for me? Let's see. Now, if the initial investment is 2,15,000, what will be your payback period? 9 months a month. I don't know. I just hypothetically constructed. I'll just rely on answer you're telling and recompute and tell you. 9 months, everyone. So again, same approach, cash flow and months. To earn the 20,000, this 20,000 you're taking whole year, no? That is 12 months. Up to 3 years, you have already earned 2 lakh. But your initial investment is 2,15,000. So how much more you need to earn to recover your investment? 15,000 more. Yes, to earn 15,000 more, how many months will you take? So x is equal to 15,000 into 12 divided by 20,000. You're getting how many? 9. So that means your payback period is 3 years, 9 months. Or you could say 45. Or rather, 45 months. That is also okay. That's your answer. Great. Everyone has got this correct. Can I go for the next one? Last concept and one problem and we're done. Okay, in fact, advantages. Can you tell me the advantages of payback period, sir? Very easy to calculate. Hardly any, it didn't do, no sweat, no blood, nothing. So easy to understand, easy to calculate. That is your 2 advantage. Can you remember this much? If at all it comes. Easy to understand, easy to calculate. Disadvantage. 1, it ignores the present value concept. Rather, it ignores the time value of money. Okay. Another one is, it ignores cash flows after payback period. Like here, okay. Do you think project has to, in this question number 3, what was your initial investment? 2 lakh. And you recovered that 2 lakh by which year? Third. Does it mean your project has to get over by 3rd year only, or it can continue still? Because your goal is to recover the investment or make a lot of money. Because once you recover all your investment, your cost is covered. Now only you will start feeling comfortable and the Josh will come. Because now you are getting, till now you are in break-even point zone. Now you are going into margin of safety zone. Correct or no? Okay. So does payback period consider the cash flow, or does it give importance to the cash flow beyond 3 years in this example? It does not worry about it. That is one of the disadvantages. Any cash flow from the project that you are generating after the payback period does not consider. That is a disadvantage. Is it okay? I've given that. It ignores cash flows after payback period. Advantage, disadvantage over. Next one. Payback reciprocal. It was asked in one of the RTPs. Name itself is saying payback reciprocal. So payback reciprocal will be given by the formula. Reciprocal means ulta, no? So if you do 1 divided by payback period, you're going to get something known as payback reciprocal. Simply 1 divided by, or maybe I'll write fully for your reference. Payback reciprocal is equal to 1 divided by payback period. That's what the reciprocal means in mathematics, correct? No? Just do the reverse. That's it. Or numerator becomes denominator, denominator becomes numerator. So hence 1 divided by payback period is nothing but your payback reciprocal. Okay. Now what is this payback reciprocal is? They say they've done some analysis again, some tested with some data, and they say, have you calculated IRR again? Have you calculated IRR? Yes. They say payback reciprocal, which I'll call it as maybe PR. Payback reciprocal will almost equal to IRR, or rather will approximate to IRR, not pi to pi. It will be more or less equal to IRR, provided if the payback period, or if the life of the project is at least twice the payback period. This is the analysis, or the conclusion they've drawn from their analysis. Who tested? Don't ask me. I don't know. Okay, they put it up over here. Okay, so what they, as per their analysis and testing, they say payback reciprocal will be more or less equal to IRR if the life of the project is twice the payback period. Suppose the payback period is 5 years. Okay, you're doing a particular project, so payback period of that project is how many years? 5 years. Payback period means what? How much time you will take to recover the investment. Here the initial investment you can recover within how many years? 5 years. Just because you are able to recover the investment by 5 years, will you stop the project or project will still continue? Let us say life of the project is 10 or 11 years. Let me take the first initial one. Let's say the life of the project is 10 years. Okay. Sir, what is the payback period? 5 multiplied by 2. How much you're getting? 10 years. So if the life is the same, if the life of the project, if it is double the payback period, they say, then IR or payback reciprocal will be more or less equal to IR. Another way to calculate IR. Don't use this in exam unless they ask for it. If you ask them to calculate IRR, means calculate IRR conventionally only. This is just their hypothesis. If they specifically say payback reciprocal, they may ask this as a theory question. I think once it had come, maybe once in RTP as well as once in one of the examination question. Explain payback reciprocal or something. As a short notes, I think they had asked for 2 marks, if my memory serves right. This is what you'll write. One, you'll write the calculation and you'll write what? One more point. Payback reciprocal will equal to or approximate. Will approximate or will be more or less equal to what? IRR if life of the project is is at least twice. The keyword there is at least. I've just written as equals to for simplicity. The life of the project should be at least equal to twice the payback period. Okay, if I have to modify this example, let's say payback period is 5 years. Life of the project is 11 years. Question is, will payback reciprocal be more or less equal to IRR? Yes or no? How are you concluding? Because life of the project is at least twice. If you calculate twice, it will be what? 5 into 10, which is 10 years. Is the life of the project at least 10 years? 10 years and above is okay. But below 10 years is, then that scenario as per the hypothesis will not work. Meaning, in this case, will it be? Yes. If, however, life of the project is only 9 years, then will payback reciprocal, will it be equal to IRR? Will it approximate to IRR or no? No, because twice of the project is what, sir? 5 into 2 is 10 years. That is a twice of the payback period. But is the life of the project 10 years or lesser than that? Lesser than that. Hence, in this case, it will not work out as per their hypothesis. Okay. That's all. Just write these 2 points. How to calculate? And this will be more or less equal to IRR if the life of the project is at least twice the payback period. It's both called out in the chart and here also they have given. Just write that. That's sufficient. Question number 4, the last one for the day. A project requires initial investment of 20,000. It would give an annual cash flow of 4,000. Super. Every year cash flow is different or same? Same. If it is same, means what will be your payback period? Not payback reciprocal. Payback period. How do you get payback period? Initial investment divided by annual net cash flow. Initial investment is 20,000. Annual net cash flow is 4,000. So your payback period is 5 years. Easy now. So the useful life of the project is also 5 years, it seems. Okay, fine. Calculate the payback reciprocal. So how do you get payback reciprocal? 1 divided by payback period. Payback period, you already got it. 5. 1 divided by 5 you do. It is 0.2 or 20%, because we are equating payback reciprocal with IRR. IRR is always a return expressed in percentage. So this is 0.2 or 0.2%. But here, will payback reciprocal, will it approximate IRR? Here, will it approximate? Shwara? Life of the project is 5 years. Payback period is also 5 years. Payback reciprocal will be more or less equal to IRR if what? Life of the project should be double, at least double of the payback period. That means life should at least be 10 years in this case. 5 into 2, which is 10 years. Is the life of the project 10 years or lesser than that? Lesser. So here it will not work out, but you need not mention that because any which way that they ask for it, no, they only asked us to calculate payback reciprocal. So you can stop your answer at payback reciprocal itself. Yes, sir. Any questions or done? Done? Okay, so that's it for today. We'll catch up tomorrow, same time. Take care. See you. Good night.